What's up YouTube, it's Andrew here. I'm gonna make a quick all-encompassing video about taxes when trading stocks. I'll leave a timestamp to each moment in the video so you can skip around to that moment. After striking gold in the stock market and creating generational wealth with correctly timing the market, you're probably wondering how much money is Uncle Sam gonna steal from me? Will it be like a communist regime with 70% taxes, or will it be like how much politicians pay? Well, there are many factors that affect your taxes. It could be your investment style, whether it's short-term or long-term, or it could be your investment vehicles. This video will briefly touch upon topics, and in the future, I'll dive into the nuances of each topic. If you appreciate the hard work into putting together all this information into a digestible watch, please hit the like button and consider subscribing. When you sell a stock for more than you've paid for it, that profit is called capital gains. Now, not all capital gains is treated equally. If you've held onto a stock for longer than a year, then that is called a long-term capital gain, and you might qualify for lower taxes. The capital gains tax rate is 0%, 15%, or 20% for most assets held longer than a year. But if it's less than a year, it's called a short-term capital gain, and you will likely pay higher taxes on it. Capital gain taxes on assets held less than a year correspond to ordinary income tax bracket: 10%, 12%, 22%, 24%, 32%, 35%, or 37%. Dividends can be qualified or non-qualified. Qualified dividends are typically taxed at a lower rate, similar to long-term capital gains. According to the IRS, the following requirements must be met for a dividend to be considered qualified. The dividend must be paid from a U.S. corporation or a qualified foreign corporation. A qualified foreign corporation is one that is incorporated in the U.S. and is eligible for an income tax treaty with the U.S., or the stock is rarely traded on the U.S. exchange. The dividend cannot be a non-qualified dividend, which we'll discuss later. The shareholder must meet the holding period. The shareholder must have held the stock for at least 60 days during the 121-day period that begins 60 days before the ex-dividend date. The ex-dividend date is the first day after the day a shareholder is entitled to a dividend. The holding period is altered if you're holding a derivative instrument on the underlying stock. Non-qualified dividends, on the other hand, are taxed at an ordinary tax rate, so it's crucial to know what type of dividends you're investing in. Those dividends that did not meet the requirement of a qualified dividend, as previously mentioned. Capital gains distribution are dividends paid from a tax-exempt corporation or farmer cooperatives. Dividends paid to an ESOP, employee stock ownership plan. Dividends on stocks where you hold a short derivative position. Payments in lieu of dividends. Dividends paid by REITs or MLPs. Non-dividend distributions. Payments made that is not from earnings or profits. Liquidating dividends. You may ask, how do I know if my dividends are qualified or not? You will receive an IRS form from 1099 div from the company or custodian at the end of the year. Qualified dividends would show in box 1B, whereas ordinary dividends would show in box 1A. The watch sale rule, the ultimate laundry day for stocks. This rule prevents you from claiming a loss if you repurchase a substantially identical stock within 30 days. It is designed to prevent tax-motivated selling and rebuying, so plan your moves carefully to avoid this wash sale trap. If you do sell a stock at a loss, you're able to write it off for gains up to $3,000 a year. If you lose more than $3,000 a year, you could save that for another year. It's referred to tax loss harvesting. Plan carefully to avoid unintentional consequences. Lastly, let's chat about tax retirement accounts, the rock stars of tax efficiency. Contributing to tax retirement accounts means using pre-tax dollars, reducing your taxable income. Plus, the investments in these accounts can grow tax deferred. But remember, when you start withdrawing in retirement, those withdrawals are subject to ordinary income tax, and you are required to make withdrawals after the age 72. Example of tax-deferred accounts are traditional 401ks, 403bs, and IRAs. A unique tax-deferred account is a 529 savings account. It has tax-deferred growth. Contributions grow free of federal and state income taxes. While in the account, no income tax is paid on the growth of your account when withdrawals are used for qualified expenses. However, if you don't use it for qualified educational expenses, you will owe both taxes and a 10% penalty on earnings. Also, you can gift up to $85,000 to a member of the beneficiary's family. That includes spouses and in-laws. Remember, tax laws are subject to change and they also vary on the individual circumstances. It's always advisable to consult with a tax professional based on your individual situation. Here was a brief explanation of taxes in the stock market. Please comment any financially related topics you'd like me to make a video on. If you did enjoy the video, please leave a like and consider subscribing. And as always, thank you for watching. See you in the next video and happy investing.